but yet important. This concept is levying a tax as a minimum amount, and it's the second method. It's an alternative to the main tax that is imposed as per Finance Act. This concept applies to all persons other than companies. And the reason companies are excluded, so for companies, there is anyways the concept of MAT applicable. MAT is under section 115JB, and this is 115JC onwards. A minimum amount of tax needs to be collected or is imposed. What happens is, say we are talking about all persons other than companies. Best example, an individual. An individual pays tax according to slab rates. So his income is spread over slabs. A certain part of income, zero tax is imposed, basic exemption limit. Then on certain part of income, tax is imposed at 5%, then at 20%, then at 30%. If in your total income you have special incomes like capital gains, dividend incomes, so they have their own rates of tax applicable. Casual winnings has its own tax rate applicable. So because of this, your average rate of tax gets pulled down or is distorted. If your total income is say 8 lakh rupees, you fall in the 20% slab, but you don't pay 20% on the whole 8 lakhs because the 8 lakh got divided into slabs like this. If your total income is say 14 lakhs, 1-4, you fall in the 30% slab. But what if in the 14 lakh rupees you have short-term capital gain under section 111A, which is taxed at 15%. You have long-term capital gain under section 112A, the section which was the last year's amendment. Long-term capital gain on equity shares, mutual fund units now becomes taxable. The stock market gains are now taxable. That's taxed at 10%. So even if your total income amount falls in the 30% slab, you don't end up paying 30% on the entire amount. The average rate of tax is far less. This is where this alternate minimum tax is imposed. You have deductions in respect of some incomes, ATI-A, ATI-B. So you're earning those profits, but you're not paying tax on it. You're paying tax on the total income. Total income is after taking those deductions, income-based deductions. So the problem is that you are earning income, taking a deduction of that income, and then paying tax on the balance amount of income. That means government is getting lesser tax, and so it created this alternate method. It said that you calculate your regular tax payable on total income. What is the meaning of this total income? Gross total income minus your chapter 6A deduction. Chapter 6A deduction means all your deductions from ATC to ATU. On this you calculate your regular tax. Since we are talking about persons other than companies, it means individuals which will be covered by slab rates, partnership firm which will be covered by a flat rate of 30%, and incomes like capital gains, casual winnings which have their own special tax rates. So your regular tax is calculated on total income. So you calculate this slab rate, flat rate tax. Of course, add surcharge, add health and education cess. This is the first calculation. If this amount is less than the alternate minimum tax calculated at 18.5%, 18.5% plus surcharge plus health and education cess, everything. And this is calculated on adjusted total income. Now, if this happens, if your regular tax is less than the AMT, then for that particular assessment year, the meaning of the term total income will not be the total income calculated as per regular provisions. It will mean the adjusted total income, and the tax that is payable is your alternate minimum tax, which is calculated at 18.5% plus your surcharge plus health and education cess. Then this AMT is your tax payable. So numerically speaking, let's say my regular tax works out to 3,20,000 and my alternate minimum tax works out to 3,70,000. Then for that assessment year, I am supposed to pay 3,70,000 because that is the minimum tax. Vis-a-vis this, if I create an example of 420 and 380, samjho. Now the government is saying that as per the regular provisions, as per the budget provisions, as per the Balance Income Tax Act, your tax payable is 4,20,000. The rates that are announced by Finance Act plus the rates existing in Income Tax Act other than AMT provisions, that tax is 4,20,000. And as per AMT, the minimum tax is 3,80,000. So minimum, bare minimum, we want 3,80,000. Your regular calculation is 420. So what are you going to pay? 420. So when does this AMT concept apply? Or when is AMT payable? AMT is payable, alternate minimum tax is payable when your regular tax is less and alternate minimum tax is more. The whole idea is to levy a minimum amount of tax, or is to collect a minimum amount of tax. Minimum 18.5% on that adjusted total income. Compare that with the regular calculation that you normally do as per the Balance Income Tax Act and the relevant Finance Act. If your regular is more and AMT is less, then this provision does not apply only. Then you pay the regular tax. If your regular is less and AMT is more, then you pay AMT. So bare minimum, government will get the minimum tax. Now, if I put this example a bit more systematically, let's say for assessment year 2021, my regular tax is 3,20,000 and my alternate minimum tax is 3,70,000. So what am I supposed to pay to the government? 3,70,000. Fine. If I am supposed to pay 3,70,000 as an assessee, I will feel that this is wrong. You're taking more tax from me. You announce the budget, you give me the slab rates or the flat rate as per the budget. There are already sections existing in Income Tax Act which give me special rates. According to all of that, my tax liability works out to 3,20,000. Now you come up with something altogether different. Now it's like a wild card entry. बोला ये अभी alternate tax भरो. Minimum तो हमको 370 चाहिए ही चाहिए. So the government says, okay, since we are imposing a minimum amount, since we are collecting a minimum amount, we will give you a tax credit. So the extra that you are paying is your tax credit. In better words, I would call it as AMT credit. I'll say the difference extra that you are paying is AMT credit. What does this mean? This means that now the provision that is created is if regular tax is less than the AMT amount, then you are going to pay AMT, but the extra that you have paid will be your AMT credit. That means the AMT amount minus the regular tax. हाँ तो सर ये credit का क्या करने का? This credit is to be carried forward for a span of 15 assessment years. And when you carry forward something, what do? You set it off. So in a future year, you will set off this amount. How to set it off? The year in which your regular tax exceeded the AMT, then set off is allowed in that year. So set off will be done for that particular assessment year. Now I will be setting off. What will I set off? The AMT credit. That means, what is AMT credit, by the way? It's an extra tax that I've paid. So the extra tax that I paid in a past assessment year is now being allowed to me as a credit. I am taking that extra amount and I am setting it off. But I still have to ensure that the provision of AMT is satisfied. That government still gets the AMT, still gets the minimum tax. So the set off amount is, in that particular year, what is the AMT credit available, and compare that with the regular tax minus AMT for that particular assessment year. Out of the two, whichever is less, this is your amount of set off. So if I continue this example, say assessment year 21-22, 4,60,000 is regular tax, 4,85,000 is AMT. What will I pay? AMT. I am paying something extra. So that extra is AMT credit, which is carried forward. Now in 2022-23, example 1, regular tax 5,10,000 and AMT is 4,45,000. Now is regular less than AMT? Is regular less than AMT? No. Then as per the main provision, regular is not less than AMT. I don't have to pay AMT. I have to pay the regular tax. So case 1, my regular tax 5,10,000. But now what I will argue with the government is, in the past 2 years, I've paid 75,000 rupees extra to you in the form of AMT. You created this alternate minimum tax and you said pay AMT minimum amount. So I've paid 75,000 rupees extra to you. Now give me a credit of that 75,000. I say okay, set off of the AMT credit. As per the working, the AMT credit that is available at that stage is 75. But what is the excess of regular over AMT? 510 minus 45, 65,000. Suppose I set off the full 75, the credit that is available at that stage. Suppose I set off the full 75. Then the working will be 5,10,000 minus 75,000 set off. Kitna aega? 4,35,000, which will violate the basic concept of minimum tax. So although I have a credit of 75,000, I will be able to set off only 65,000. And that means the balance tax that will be payable is 510 minus 65, 445. That means government still got the minimum tax. And suppose I tell you 6,10,000 is the regular tax and AMT is 4,45,000. Then I am supposed to pay the regular tax 610. But now my argument to the government is that till now I've paid 75,000 rupees extra to you. And the regular minus AMT today is 1,65,000. That means I can take the full 75,000, set off that credit, and the balance tax payable, if somebody can help me with this, kitna aata hai? 610 minus 75. 3 kaise aayega be? हाँ कैलसी चल रहा है बराबर 535 नहीं चल रहा है 535. So what is 535? That's the balance tax payable, which is still more than the AMT. So government is still getting the minimum amount. No interest will be allowed on this AMT credit. मतलब you are paying 75,000. You can't say कि अच्छा I've paid it to you extra in advance, तो उस पे interest calculate करो. Nothing of that sort. अच्छा in this case it's pretty obvious. If 65,000 is set off, then the balance AMT credit to be carried forward is 10,000. The 10,000 is which 10,000? Out of the 25,000. नाउ यहां तक समझा सब कुछ? हाँ, 75 is the credit available, 65 is what you are setting off, so you have balance 10. उसके पहले वाला मतलब क्या नहीं समझा? ये 75. हाँ, so government is still getting the minimum 445 का tax because here you are paying 535. You are paying either 445 or more than that, but not less. अच्छा, last thing, the concept does not get over. We'll finish it tomorrow only. But ये पूरे working में 18.5% is applied on what amount? Adjusted total income. What is adjusted total income? Adjusted total income is total income, ये वाला figure. Add back deduction in respect of incomes. That means your section 80IA to 80IE, those deductions. Add back the deduction under section 10AA. Unit in a special economic zone, 15 assessment years का deduction तुम्हारा. Add deduction under section 35AD. Capital expenditure on specified business, less depreciation under section 32 on that capital expenditure. So when you calculated this total income, you took a 3580 deduction of a fixed asset for specified business. That means you did not put it into the block of asset because you're taking 100% deduction. But temporarily, I am disallowing that 100% deduction and I'm imagining that what if I had put it into the block of asset in the current year? So half rate, full rate, normal depreciation, additional depreciation, you do all of that stuff and subtract the depreciation deduction. This amount is your adjusted total income. And on this you apply 18.5%. So income based deductions, you have already subtracted them while you calculated total income. Start with that and add back those income based deductions. Add back the 3580 deduction if you have taken a 3580 deduction for a specified business. And if you have taken, then subtract the normal wear and tear, normal depreciation. ये पूरा concept समझा?